back. Time now for a new show. It's called The Money Manager. This is where we tap into the giant brain of an asset manager or a money manager, either from overseas or from the local market. Today it's an international commentator. It's the international investment strategist from the deVere Group based in London, and it's Tom Elliott. Tom, we're going to look at the capital market today. What an extraordinary year it has been. I think more so on the overseas markets, but South Africa also not bad, not spectacular, but a good solid performance. Maybe we can start there.
Yes, I think if we go back to February and March, when South Africa, along with a lot of other countries that had and have quite big current account deficits, when we saw what was happening to their currencies and interest rates having to go up to defend the currencies, to end up with a net gain in rand terms and even in dollars on the MSCI South Africa really is a good year. And I think it's actually a testament to the fact that the action was taken early last year by the central bank that was needed to stabilise the currency.
Yeah, 50 basis points we had in January, which was a response to, I think, in the main to what was going on in places like Turkey. Then we had 25 basis points up in July. And now, of course, what people are talking about is the fact that inflation is within the target band, 3 to 6%. The currency, I mean, it's under pressure, but it's not going to the sort of terrible levels that have been predicted. Yeah. Oil price is down, and perhaps with growth where it is, the next move might even be down again.
I mean, this is interesting because when you look at South Africa in the broad data, especially at the twin deficits, the current account of the budget deficit, people have been inclined to sort of go, oh, this looks bad. But actually, both deficits are more or less in the same realm as the UK. Why don't people pick on the UK as a problem? Because we've got growth in the UK. South Africa, there's no reason why South Africa shouldn't be able, over the next couple of years, to pick up on growth, even as export of commodity prices fall, so long as some very basic recommendations that the IMF have been going on for years are pushed through. And you've got to have, just to carry on with this line, it must involve more productivity from the public sector, the product markets, openness, getting rid of some of the monopolies that control retail distribution and other things like that, and introducing mechanization into the commodity industry in a bigger way, which means, as you know, taking on the unions.
Well, what you've said now essentially is 90% political will. Do we have the political will? Because if we don't have the political will and growth stagnates between 1.5% and even 2.5%, which 2.5% seems a long way away at the moment, then we're going to have the rating agencies knocking on our doors again in a bad way.
I totally buy into that. I don't live here. My knowledge of South African politics isn't enough to give you the answer. What I can say is that it is remarkable sitting here today in South Africa as it is. Nobody would have expected this 20 years ago. And a lot of the success of the South African story over the last 20 years is due to pretty solid institutions in South Africa that I think will help produce the results that are needed. I'm talking about the Parliament, especially the Reserve Bank, that have more or less done what they're supposed to have done in ensuring growth in an open, free society.
Let's go beyond our borders now and have a look at the oil price, because that's been the story of the second half of 2014 and will continue to be a story in 2015, I think, along, of course, with these extraordinary yields we're seeing on the international markets, the US 10-year going below 2% again, I think, last week. Yes. And in Europe, you've got certain countries at their lowest levels since the 14th and 15th centuries. Can this continue, and how will it influence South Africa?
The first thing is you've got to see the lower oil price in line with lower commodity prices generally, and that's what South Africa's been feeling for some time now. Because there's an argument that oil is just Saudi Arabia overproducing to wipe out shale producing in the US, perhaps to annoy the Shia neighbours in the Middle East who are far more dependent on high oil prices.
You're talking about Iran here.
Iran, Iraq and Syria, and not forgetting Russia, which is Syria's paymaster. A low oil price hits all of those. But there's also an argument, and this is why it feeds into sort of what South Africa has experienced recently, that it's lack of demand growth from China that has put lots of commodity traders out of step over the last 12 months. And there's anecdotal evidence that the Chinese economy may just be growing at 4% if you look at electricity consumption and other data rather than the 7% official growth. Now, if that's the case, that explains why it's not just oil that's falling, but copper, iron ore,
yes,
and everything close to the home of the South African economy. Now, I think that when you look at falling commodity prices, you've then got to say, well, that means cash flow is not coming into the hands of commodity producers. Instead, it's coming into the hands of commodity consumers. What are the pressures for those commodity producers who are leveraged, who rely on that cash flow to pay for mine expansion, to pay for their imports? And this is where it comes back to South Africa with the trade, with the current account problem. It comes to Russia. Russia's sitting on reserves of $300 billion or so, but many of the companies are very highly borrowed. And as the ruble falls, because the oil price falls, how will they roll over their debt? So falling oil price and commodity prices is, to use the old cliche, it is revealing who was swimming without any trunks on. The tide is now coming out.
There's also a double-edged sword, but actually there's more than two edges to this sword, because if you look at the United States of America, for example, everyone says, well, look, I'm paying less at the pumps now, but on the other hand, a lot of the economic recovery in the United States has been due to the revolution in energy. If you look at the markets, for example, what about the Norwegian Sovereign Wealth Fund? What about that, the influence of that having less money to spend in the markets? There are so many facets to this argument.
There are. Just to throw in another one to scare the horses, you've got this point that perhaps, according to JP Morgan, 17% of US high-yield paper market is energy companies. And if they are unable to roll over their debt, yes, because they're no longer getting the cash flow because oil price has fallen, will that lead to a trigger in what a sell-off in what some believe is an overbought high-yield paper market?
Eurozone, deflation, both of those things are incredibly important. Eurozone and deflation inextricably linked, but if you look at the Chinese PPI data, I think for 34 consecutive months now, goods at the factory gate in China has been falling. So China will be exporting deflation or less inflation to the rest of the world. What does that mean for the capital market?
It's grim. It's grim for two reasons. First of all, because most investors are not familiar with prolonged periods of deflation, so they don't really know how to understand its role in asset allocation. Does it mean you go overweight government bonds when you're getting so little real return? Things are very difficult to grapple with. In terms of the Eurozone, I do believe that this is a self-made problem. I don't believe austerity in the peripheral countries is the solution. What Germany needs to do is say, look, we are the Eurozone, we're one country, take that leap of logic and look at the Eurozone budget deficit as a whole, which is just 2.5%. It's perfectly manageable, largely because Germany's is just 0.8. And say to the Eurozone periphery, we will lend you the money to build infrastructure projects, to get people working, so they're no longer going on the rallies, far-right rallies, and demanding break it if you're in Greece, leaving the euro. We need to see a fiscal shove in the peripheral Eurozone, and that will reduce the deflation fear, it'll get people working, and it'll reduce the pressure on the whole euro as a concept from its antagonists.
If you read the Telegraph every day and you read Ambrose Evans Pritchard or Jeremy Warner, they'll have you know that Mario Draghi and his cohorts have done absolutely nothing to stem the tide of deflation. But can they do it this year, and will that then scupper the bond market rally?
It's unfair attack on Draghi, if I may just make this point. The ECB has never been given the tools to act as lender of last resort to countries and banks. They've rectified those things to a certain extent over measures announced over the last couple of years, but it is an unusual central bank in that it doesn't have the power to do what a UK Fed or the US Fed can do to reflate the economy. It has to go on emergency crisis missions to Berlin to get permission to do this, or check with the Bundesbank it's okay. So it's a little unfair. I do think ultimately, and I say this as somebody who's in favour of the European Union, always has been, that I think the Euro project is a project too far. You do not have economic symmetry in order to justify one interest rate fits all. We saw that in the noughties with Spain and Greece booming away while German economy stagnated. So an one rate fits all policy was totally inappropriate. The only way you can mitigate against that is if you've got economic flexibility, like they do in the US, which means recession in a region that's in a recession. You then see people leaving it, and wages fall, and eventually investors come in to make use of those low wages, so you're back in equilibrium. That doesn't happen in the Eurozone. People don't move countries as much as is necessary, too much for UKIP's and there's no flexibility in wages. Wages just don't fall. So you do not have the economic flexibility that you need in order to make up for this lack of economic symmetry.
Oh, goodness me, there's so many things to consider when we sit down on our first morning meeting of 2015, which is mine today. Currencies, the US dollar to capital, I mean, the euro dollar is at, I think, 6.5, was it a 9-year low? Anyway, a multi-year low. What are the implications, again, for the capital market on a rampant US dollar?
Yes, the cliche in the market is everybody's saying I'm pro-US dollar, or we should be pro-US dollar, so I'm against it. That's a bit of a cliche, and you hear this. I say stuff it. Sorry if I may use such terms. The arguments for a stronger US dollar are startlingly clear. They come not only from really strong growth, that 5% an annualized rate third quarter growth that was announced in the revision announcement recently. Yes. 5% growth, that's fantastic.
And it's still the biggest economy in the world, lest we forget.
Absolutely. It's the motor of the world economy, and it's motoring along very nicely. That's going to suck in investment, helping the dollar. It's also now energy neutral. It's no longer a net importer, so that means it's not spending dollars on energy. So the trade account's improved, another plus for the dollar. So I think it's going to continue to improve. The euro, if we have quantitative easing, and I'm looking for something really big on the 22nd, I'm looking for at least £1 trillion, maybe an announcement of €1 trillion with more to come in the future, or maybe a big number from the outset.
Will it be effective, though, because a lot of the measures that they've put into place recently haven't been taken up by the banks? We don't need to go into LTROs and what the technicalities of them, but this time, will it be effective?
This is a point that a lot of the anti-quantitative easing for the ECB have made, especially the Bundesbank. They say much of European lending is done through bank loans, not through the bond market. So what's the point of making bonds even cheaper? And then they say that there isn't the demand. I think if you start bringing yields to almost zero, and then you introduced higher penalties at the ECB is charging European banks for depositing their cash, you increase those penalty charges, banks will effectively go bust if they don't make loans with the capital that they get from that quantitative easing.
I'm being unfair on you now, Tom, because we've only got 30 seconds left. I need a couple of bones to be thrown at me, some recommendations for 2015. And if you could start with South Africa and just end off with the international capital markets. Just a quick one.
I'm pro-South Africa, I'm pro-India, Philippines, and Indonesia within emerging markets. Within developed, it's large, it's the US, UK, large cap, not so much small cap, I think a bit overvalued. When it comes to commercial paper, prefer corporate grade over investment grade, don't really like treasuries or gilts, overbought. And I think it's going to be more volatile because of political things, not least Russia.
Tom, thanks very much for your time this evening. That's Tom Elliott from the deVere Group. That's it for The Money Manager. The show will be back same time tomorrow night. But stay with CNBC Africa because in a moment there's personal finance.